Hi, I'm Jimmy. In this video, we're looking at what's been happening with the stock market. And I'm sure we all understand why the stock market crashed earlier this year thanks to the coronavirus. And maybe we can even understand that the market rallied once the Federal Reserve stepped in and the government stepped in and started doing stimulus, things along those lines. Maybe we can understand at least some of the initial rally. But I recently heard that just a few tech stocks were ultimately what caused this huge rally, and I wanted to see if that was true. And perhaps if that is true, perhaps there are some opportunities out there for value investors in some sectors that perhaps haven't had the same rally. So that's the goal of this video. And then hopefully we can use that information to make better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so first, let's look at what has happened with the S&P 500 over this past year. And if we're curious, on a total return basis, now total return assumes that we reinvest any dividends that we receive back into the stock that paid that dividend. So for the S&P 500, the stock market, we're going to use the S&P 500 as a representation of the stock market. They were up about 17% for the entire year. So assuming we reinvested all those dividends that each stock in the S&P 500 paid, we reinvested that, we would have made 17% from a year ago. Okay, now that's decent. But if that would be decent in a regular year, if we consider that we had the stock market crash and then a huge recovery, well, suddenly that 17% looks fantastic. Now, if we're curious, during this time period here, coming off of the bottom of the stock market, the low of the S&P 500 back in late March, well, we're up 41% since that time. Okay, so let's look at how this happened. And we're just looking at what stocks and what sectors did well, how they performed, and which ones overall contributed to the stock market or the S&P 500 moving higher since the end of March. So I put together this table. The first column here is how much each sector represents in the entire S&P 500. So we can see that information technology represents about 20% of the entire S&P 500, so that's quite huge. And the way they determine how much weight each sector gets is how big the companies are within that sector. We'll come to the individual companies in a second. So this next column, this is a total return for this same time period from the low to where it is today. Well, we can see that consumer discretionary stocks performed the best, then information technology, then material stocks. But when we calculate the contribution to the total return, well, now we can see that information technology stocks made the biggest impact on the total stock market returns. This contributed 13.3% of the 41% that the stock market has put up since the bottom. That's more than 30% on a total return basis. So of all the returns that the stock market had since the bottom, this contributed 13%. So we'll come back to this table in a second. But for now, let's shift over to some of the individual companies. So let's scroll the list of companies from the S&P 500. And just like before, the second column is the weight that how much they represent of the total index. And we could see that Microsoft was up 45% and Apple was up 97% over this time period. Okay, so we can see that both Microsoft and Apple represent about 5.7% of the total fund each. Now, these two stocks combined contributed more than 7% of the S&P 500's performance. Don't forget, they were up 41%. So 7% of that 41% can be explained by just these two companies. Now, if you're curious, Microsoft and Apple fall under the information technology sector, while Facebook and Alphabet fall under the communication services sector, and Amazon is in the consumer discretionary sector. So that helps explain at least some of the returns for those segments. Now, as far as opportunities go, I'm a bit surprised that healthcare was only up 32% from the bottom. I would have thought that in a COVID world, they would have done much better than that. So it might be worth digging into some of those a bit deeper. I'm also a bit surprised by consumer staples. Now, these are companies that, in theory, people will keep buying their products no matter how the economy does, or at least they need these products. So things like Kellogg's, Coca-Cola, Clorox. So there's going to be consumer staples, things that most people continue to buy no matter what their financial situation is. So I think we can all agree with the fact that the stock market is up a surprising amount right now. Sure, I understand the Fed's involvement And big companies like these continue to do quite well, which is, of course, making the total stock market look much better since the S&P 500 and the Dow, but the S&P 500 is a big headline stock market index. But I would have thought that some of the more defensive names, as the stock market has moved higher, would have thought that there would have been some fear of a stock market pullback. So I thought some of the defensive names would have done a bit better. Either way, it looks like they haven't just yet. That being said, I started pulling down the price to earnings ratio, or PE ratios, for as many companies as I could get my hands on for the S&P 500. So I broke down the S&P 500 by sector. So you could pause it if there's any companies that look interesting to you. Put in anything you might think in the comments below, something we should dive deeper into. Now, I used a trailing PE, which is today's price and the past 12 months of earnings per share. And I also included a forward PE ratio, which is today's price, stock price, and the expected next 12 months of earnings per share. And I did both because I figured that many companies might have skewed numbers. It's easy to look at a company that had their earnings hit during COVID and say, oh my God, look at how overpriced this is. A good example of that is Disney. Clearly, this is a crazy high PE ratio. Now, I personally bought Disney during the COVID crash. When it first started crashing, stock dropped below 100. I personally bought it then. I still own that today, if you're curious. But this looks way more overvalued since earnings have been hit with their parks being shut down and with some of the movie theaters being shut down, things along those lines. So as we scroll through some of these individual sectors, I also think it's important to point out that perhaps price to earnings ratio isn't the best metric to look at in this type of situation. A good example of that is this whole real estate sector here. Well, we can see that these real estate PEs look crazy high. But one of the reasons for that is PEs aren't actually great for REITs. Much better for that, instead of a price to earnings ratio, would be something like price to funds from operations. So if you're curious, switching that one out, we'll run the price from funds from operations now, and we can see they look a bit more reasonable. So I wouldn't take the PE ratio at face value in that case. So I do think that using PE or some sector-specific metric is a good way to identify potential companies to look closer at, companies that we might want to research a bit further. But once we find those companies, I think it makes more sense to do an in-depth valuation using more than one valuation method. Don't just lean on PE or even price to funds from operations. I think it makes sense to use 2 or 3 different valuation types to get a better understanding of what the intrinsic value of that company could truly be. And if you're interested, I actually did a video where I go through some of the more popular valuation methods and where to apply them in different industries, which industries to avoid with the different methods, things along those lines. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.